Hey gang, it's John Suzuki. Coming up on our Finding Better podcast, I have Andy Parrillo joining me. Andy spent 40 years in financial services. And the world wants us to think that building wealth has to be complicated. Andy's joining me to dispel all that, to talk about savings, talk about how to invest, talk about options that you have, and talk about how to win in building your wealth. This is one that you're going to want to listen to over and over again, maybe a couple, three times. And please share it because it could change somebody's life. Here we go. Hello, 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 and welcome back to our Finding Better podcast. My name is John Suzuki, and I am your host. And this is where we share real life experiences. We don't share theories, we don't share opinions, we don't share academics. It's all about sharing real life experiences of what we've done in our lives to find better. And it can be about better money, it could be about better friends, it could be about better jobs. We talk about everything. And the idea is that, sometimes a great path to success is to copy it. Now, today we're going to talk about one of my favorite topics, and that is money. And let me tell you why. My guest today is Andy Parrillo. And Andy wrote a book recently called Beat the Wealth Management Hustle. Okay. Now, we're not here to sell his book. We're not here to sell his book. We're here to talk about his experience and some of the things that he talks about in his book. And the thing is that I hope you will, first of all, take out a piece of paper and pencil because we're going to talk about a lot of things, and we're going to take a really complicated, a potentially complicated and daunting topic of managing your money, and we're going to try to simplify it. Okay. Because, it's funny because you hear all these commercials and you hear people talking about how complicated I think part of the thing is that people want us to think that managing money and building wealth is complicated. And so Andy is here after 40 years of being in the wealth management industry to really distill and talk to us about what it all means and the whys. And I think that at the end of this episode, you're going to be pretty pumped up. You're going to be pretty pumped up to really to first of all in understanding, having a new perspective on this thing called wealth and money, and hopefully deciding to take control. Okay. So with that, I'm sorry it was such a long introduction, Andy, but I am really, really passionate about this. And thank you for joining me. Welcome to our Finding Better podcast.
Well, thank you, John. I'm delighted to be here.
Yeah, I know that I've learned a ton from you. And the thing about it is that we live in a society where it's really, really tough to save money and build our wealth because we live in such a instant gratification world. And on the other hand, people aren't taught to live within their means. We have credit cards being thrown at us all the time. Most people are in debt. And one of the things that I say to folks is that wealth is not defined as how much money you make. It's defined as or one definition is how much money you keep. And we see people all the time driving around in fancy cars and BMWs and Teslas, and they're broke. I mean, if they're making $500,000 a year, but they're spending $501,000 a year, they're broke, right? And so we're gonna get into this, and I'm gonna shut up now and let you talk. But what are some of the key messages that you'd like to share with folks as they think about their futures?
Thanks, John. Well, I guess that the first one is let's try to keep it as simple as possible. This is not, and when I say something simple, it doesn't mean it's simplistic. It just means that it's straightforward and should be a common sense approach. Okay. So
Right.
the first order of business is the decision that people have to save. And that's difficult, as we know, because we probably live up to our income. And don't think about setting aside money. So what would help people to do just that is to get incentivized to save money. And the answer, I believe, is, and what's really available these days is we could easily go to an internet search and find a calculator for compound interest. And compound interest, as Einstein said, is an eighth wonder of the world. And people sometimes do not appreciate that. And I think that if you go to the internet and do a search for compound interest calculator, you'll find a very simple calculator, and you can put some numbers in. And the numbers you put in are how much do I want to save, and just call it $1,000. Okay. And maybe you can save $1,000 a month, or maybe you can save $1,000 a year. Whatever the number is what you put in, $1,000. And then the next thing is you put in how many years you want to compound it for. And I would just suggest putting 20 years in, just for starters. You can put whatever. You could put a year, you could put 10, 50, you could put 100 years, but put 20 years. So it's a reasonable time frame for saving is 20 years. It's actually longer than that, but and then, how much you want to put in every month, you can put that in the calculator. And you should do that. You say, well, okay, I want to put $50 a month or $100 a month in. Start with 1,000, I'll put 100 a month in, and I'll do it for 20 years, and I'll compound it. I'll have an interest rate of, and let's just be, realistic here and say it's 5%. Okay. We know we'd like to make more, and we can, and we'll talk about how to do that in this podcast. But let's just say, so put 5%, so $1,000, $100 a month for 20 years at 5%. And I think that you will be astonished at the end number at 20 years. And that should be some incentive for people to put what really is a fairly modest amount of money into savings every month for 20 years, $100 a month for 20 years. And that will put you in a position, 20 years hence, that'll be a lot better than had you spent that initial $1,000 and $100 a month on an extra meal or two at a restaurant, for example. So that's the first order of business, is the decision to save. And the academicians call it a time preference decision, but you don't have to know that. All you have to do is know that if you save money and you compound it at even a modest 5% a year, it gets to be a meaningful amount of money. Anyway, so that's the first thing I would suggest,
So
John.
just real quick on that, Andy, I don't know what the statistic is, but and I can look it up. In fact, I will look it up in our next segment, and then I'll come back. But the percentage of people who even have $1,000 in savings is really, really, and this is in the United States, is remarkably low. And so the question is, you know, how do people save? And $1,000 to a lot of people is a lot of money. So do you have any thoughts on that? And I'm gonna hop on and try to get this statistic. But yeah, how do people save even $1,000? So saving $100 a month, how do people do that?
Well, as I said, it's difficult, and you have to have an incentive. You have to have a reason for it. What is the reason to do it? Now we know inflation is with us. We can't do much about it on a day-to-day basis. We still have to buy basic things that we need. Our decisions to spend are obviously are going to determine how much we have left over from our earnings to save. But again, if you have enough incentive to do something, you'll do it. I mean, if you're headed down a river towards a waterfall, and you haven't started rowing before you get there, you better start rowing now. So that's kind of the point. And why would you do that? Well, because if you go over the waterfall, you're probably going to get really a bad outcome. So if you don't save, you're going to be in a tough position in the future. And it's very difficult to do that because inevitably life throws curveballs at us. We
Right.
have a washing machine that breaks down. We have a car that needs service. We have, various things come along. We know that. And going into debt to do those things may be necessary for some of us, but we have to understand that doing so is a fairly expensive proposition. So if we had a cushion of savings, that extra few $100s to fix the washing machine, or, $1,000 to fix the car, wouldn't hurt us so much. And if we have savings, that we can use for a reserve. And
You know,
it's often said, and this is almost impossible for people to do, but financial advisors, of which I am not one, by the way, I'm an investment advisor, but will say you should have 6 months of liquidity in a savings account in the event that you have a mishap or you lose your job. You should have some liquidity. That's pretty hard to do, but the only way to start doing that is to start. Okay. And easy for me to say, hard for people to do.
Right, right.
And let me tell you, John and I have both been through this. I mean, we've been to a few rodeos, so we know what we're talking about here.
Yeah.
And trust us, it's well worth the personal satisfaction and financial well-being for yourself as well as those whom you care for, your family, to do so, to make this hard decision to save. Hard to do, easy to say, hard to do, but if you don't do that, you will probably be in a less favorable position.
Well, I'll tell you that you said a lot just now. Okay. And I just want to let folks know that when Andy says that ideally you have 6 months of liquidity in savings, that means 6 months of how much money you spend every month. So if you're spending, if your expenses are $1,000 a month, ideally you have $6,000 in savings at least. Okay. The other thing I just wanted to share is that Andy and I are both retired. Okay, whatever the heck that means. I haven't been working so hard in my life, but I'm now working on things I want to do, and my quality. And so is Andy. I mean, here we are on this podcast. You know, Andy's selling. Andy's book is not it's not going to make a difference financially in his life right now, but we do know that we do know how things work, right? Now, as we talk about saving, okay, I have another way of looking at it as well, and that is taking a look at what you spend your money on. And, for example, a lot of people buy lunch every day. They go to McDonald's or they go to Subway, or they go to a restaurant, or they go to a food truck, right? And they buy lunch. They go to Starbucks every day. Okay, so the average lunch these days is $15. Okay, 13 to $15. Let's say 13. Now, if instead of buying your lunch every day, you go to Costco or Walmart and you buy lunch food for $3, yes, I've done it. I do it, right? I make an egg sandwich for lunch. Okay, that's like $1.50. So I'm saving $10 a day. Okay, $10 a day times the number of days in the year is over 3,500 bucks. You know, drink one less beer. Drink one less. And my coffee costs 15 cents a cup because I go to Costco and I buy instant coffee. You know, instead of spending $5 a day. So if you do that and you take a look at those things that are kind of crazy to spend money on, um, pay yourself. Pay yourself. And that's what to me, Andy, I know that you've got a view on paying yourself first. Please share it.
Well, no, John said it. He's said everything that I think that we have to think about, and without over sort of analyzing it. And I think that part of what we're regaled with from the media with all kinds of advertising to buy this, buy that, do this, save this, do that, and
Yes.
that's very influential. And then there's a term for that, it's subliminal. Okay, so we may not recognize at the time, but we'll think, hey, wait a minute. I just walked by this item at Walmart, say. And by the way, that's a favorite store of mine. Okay.
Yeah, me
It's
too.
really an amazing, as at Costco is as well. But anyway, but so because I like value. And we say, so we walk by this item that we've seen, 20 times on, on the internet or on television or somewhere. And it kind of reminds us, oh yeah, I think I'm gonna try that. I'll get that. And so we're spending money on things we may not really need. Do we really need whatever that might be? And the answer is probably not, but it makes us feel good to get it. All right. But so the price for feeling good for that moment or that day or that week, even, for whatever it is you're getting, it means something. It means something to you. And so, and I know we're sounding like we're scolds here. I'm not scolding anybody. I'm not just trying to tell people that,
We just
hey,
love you guys.
I just want, we're not scolding anybody. We're just trying to say, hey, look, this is simple stuff, guys. And let's just kind of let's not overanalyze it. And I do want to get into the meat of of the really exciting part of savings. Okay. And
Yeah, just one more quick comment, and we'll go right into it. Okay. Folks, if you can make a shift in your mind from feeding your ego by spending money to feeding your life by saving money, think about it, okay? Because so much of what we spend our money on is based on advertising, all these communications of inadequacy, that you're not going to be adequate. You're not going to be happy unless you buy my product. Just stop it. And so if you think about not spending your money on your ego and spending your money on your life, which means paying yourself and building up that financial health. Um, it's life changing. And the last thing I'll say, I'm sorry, Andy, is that if Andy and I didn't follow the principles that we are suggesting to you, that frankly I wish some of the things that Andy's about to tell you, I wish I knew 30 years ago. But a lot of these principles, if we hadn't followed them, we wouldn't be at a point to where we're able to retire and spend the rest of our life, probably 30 years more of our life, doing the things we want to do. So, okay, so we're done with that. Just decide. We told you how to save. We're going to go into the meat of it. Please, Andy, thank you.
yeah, yeah. Well, no, it's true. I mean, again, I just it's if you think about it, I think you'll agree that we probably spend money on things we really don't need exactly. And so anyway, let's do that. But the exciting part about saving, okay, is actually earning money with that savings. So we all have worked at a job or a profession, and possibly and most of us have worked for other companies. And think about it this way. So if we save and invest in those companies, okay, which we can do, by the way, we'll talk about that, which is easy for anybody to do, even with $100. You don't need a lot of money to do this. You can put those companies to work for you. Okay. And that sounds, what's he talking about? Is he crazy? And I'm saying, no, I'm not crazy at all, because that's literally what you're doing. If you buy $100 worth of an index fund, and let's call it the Standard and Poor's 500 index fund, and that is a composite of 500 quality companies in which investors generally look at as the benchmark for an investment that's a prudent investment, a relatively safe investment. That doesn't mean that investment goes up every day, every week, every month, or every year. It does not. Okay. But over time, over 100 years now, it's gone up 10% a year. Okay. So earlier I talked about a 5%, return. Let's say you put in not 10, but put in 7% return. Well, 7% would double your money every 10 years. Okay. So that initial $1,000 plus whatever you put in, is going to be doubling every 10 years. And the math on that is pretty astonishing. And we don't think about that because, we weren't taught this in school. Yeah, we went through math and algebra and calculus perhaps, but, did we really apply it to our own personal life? And the answer is probably, we probably didn't, um, but we should have. And it's just the simplest lesson in the world. So that, so, and all right, so
And
I already mentioned something that's really intimidating to most people, and that
Andy,
is,
just real quick, intimidating most people. I just want to reemphasize what you just said. They don't teach this stuff in school. Okay? They don't. And one of the things I hear from people all the time is, why isn't anybody teaching us this stuff? So here we are. Okay? We're trying to teach this stuff to you. I'm sorry, Andy. Go ahead.
no, no, you don't have to apologize. It's true. I don't know why that is. It's for whatever it's worth. I mean, when I was in college, we had a lecturer come in, I think in my senior year, from it was Merrill Lynch actually, and this gentleman talked about investing for an hour, and that was like the first time I had ever really heard about it or even thought about it. And I was 22 years old. Okay, I should have been doing this a long time. All right, ago. And then again, when I was in the Air Force, there was a one of our instructors took an hour out of our one of our classes to talk about at flight school actually to talk about investing and that was in the late 60s actually or no it was 1970 but anyway the point is that there was so I've had like 2 hours of formal instruction on investing in my life until I actually got in the business. Okay.
Which and how old were you when that happened?
Pardon me. I was boy I was in my early 20s when
Okay, so and all the way up to your early
I got
20s.
a job at a bank. I was in a training program. They put me in the investment department. I had an amazing mentor in that organization who kind of led me through. And at a very young age, I was responsible for managing significant accounts for clients or customers of the bank in a retirement department.
But
And
I'll say you were
anyway,
one of
so
the
so
lucky
that's the
ones.
history. But the point is that there's very little education on this. And what's cool now is that what we John and I didn't have when we were younger was the internet and all these incredible resources that are available, including YouTube videos from people like Warren Buffett.
Oh my
Okay.
God, yes.
And it's so and Warren Buffett is probably, one of the best investors, most successful investors in history, at least who's alive at this point. And he's still cranking out the investments. The and he keeps it simple. He keeps it simple. Don't bet against America. Don't bet against the market. Just invest for the long term and be patient and resolute. And that's really easy. And you're going to say, yeah, well, that's easy for him to say. He's a multi-billionaire. Well, yes, but he didn't start out that way. And so,
Right.
but look where he is. So and not that you're going to become a billionaire doing this, but you could become a multimillionaire doing it, even with modest amounts of money at a young age. Because the one thing you have, if you're young, is you have time. The most valuable thing any of us have on this earth is time. So we have to make the most of our time. So all we're saying is carve out a little bit of that time to save some money and then invest it. And then learn how to maximize your return on that investment. And we'll talk about that. So
Yeah. So and what Andy said, Andy, I'm sure that you know a lot of people who are your age, are in our age range, who can't retire, who have to keep working because they didn't take advantage of that time element that you're talking about, right? And so, what Andy said about the power of compounding being the eighth wonder of the world, according to Albert Einstein, is true. So this is really, really key. When people come up to me and say, "Hey, John, I'm your age. How do I retire?" Well, I started 35 years ago, right? And so the sooner you start, the more advantage you're going to be able to take of that time element. So, all right, Andy, thank you.
yeah, no, it's true. So what John said at the outset, we're not talking about theory here. We're talking about our reality. I mean, this has been our reality, and so we've seen it, we lived it. And it's natural for people to be concerned about the uncertainties of the future. And we can't really measure uncertainty. In the investment world, and this is going to sound technical, and maybe it is, but in the investment world, you can measure the probability of risk. Okay, not uncertainty necessarily, but risk. So, and basically, I want to say this: more things can happen than will happen. So most people are going to look at the world and say, "Oh my goodness, we might have a war a nuclear war because Putin is now threatening, nuclear detonations." And that would be Armageddon, frankly. But
Yep.
but will Armageddon happen? Well, we hope not. If it does, I'm not sure there's much that any of us can do about it.
Yep.
But let's just move forward with our lives. But we can assess risk of investing. And so um, the that's possible. And basically, here's the way it works. Okay, so we put money into the Standard & Poor's 500 index, which doesn't cost really much of anything to do, and you can do it with as little as 100 or 200, a couple $100 at any of the big firms. And they will give you, if you call them, they will tell you how to do this. It doesn't cost you anything. And you can then start out. Okay. And then what should you expect? Well, we all would like to know what we can expect in our lives. And that's just a natural part of living because we want to protect ourselves against adverse outcomes. Well, if you invest in stocks, you have to understand reasonably what you can expect. So I'm going to tell you something that, again, sounds technical, but it's true, at least historically. Okay. I said earlier that the stock market, the S&P 500, has gone up, has returned about 10% a year for 100 years. Now, it hasn't done that in a straight line. Okay. It doesn't go 10% a year. There are some years when it's been down 50 or 60 or more percent, and it stayed down for a couple of years. So that has happened. And the people who have succeeded with their investment programs and who have lived through those horrible, terrifying declines in value in the stock market, bear markets, so-called, okay, stock market declines are bear markets, if they have had the resolve to stay with their investment program and continue to keep putting money into that index, they have recovered everything that had a decline in value and more. Now, people are going to tell you, Wall Street will tell you, well, look, if you're down 50%, you have to go up 100% to regain your loss. And that's true. That's just pure math. That's absolutely true. And that here we could help you save yourself from being down 50%. Well, maybe they can. And if they can, more power to them. But I would just say if somebody's making that claim to you, then you should understand how they did it and how they're going to do it in the future. Because the stock market, and Warren Buffett will say this, and I've said it in our studies, statistical studies have shown, it's very, very low probability that anybody can actually time their exposure to the stock market. That is to say, get in when it's low, get out when it's high, get in when it's low again. And, and that's almost impossible to do on a consistent basis. And I won't give you the numbers, but they're daunting. I mean, it's not something that most people should engage in. And why shouldn't they do that? And it's interesting. If you look at the studies that have been done, people just they get fearful, and it's normal. It's natural to be fearful of a decline in the value of your account. Okay, and to be even terrified at the value.
Right.
But you have to resist that. And one of the things that, again, I'll keep quoting Warren Buffett, but he says, be fearful when others are greedy, and greedy when others are fearful.
Say that again. Say that again. Say that again.
Be greedy when others are, what I said, be greedy when others are fearful, and fearful when others are greedy. Yes. So when people start saying, "Oh, the stock market is going to the sky," it's going to go up 15% a year forever, which, by the way, before the dot-com crash in March of 2000, and some of you may remember reading about that or experienced it yourselves.
Yep.
The market for 10 years had gone up like 16 or 17% a year on average for 10 years. And people's expectation when they did these polls was, oh yeah, it's going to go up 15% a year for 10 years. Well, guess what? It didn't do that. It actually went down for 3% a year for the succeeding 9 years. That's what happened. And that's for reality. Okay. So if you held stocks for the 9 years ended June of 2009, you would have been down over 30% in value, down 3% a year in stocks. And people were saying at the time, well, why should I do that? I can't stand that. That's not going to work for me. Well, if they stayed in, they would have recovered all of that loss and made even more. Okay. The same thing happened again in the great financial crisis when the stock market started crashing in September of 2008. It actually started going down in October 2007, but most people look at it. And we almost had a failure of our financial system. It was pretty scary, but it did come back. And then again, another test of people's will who invested in stocks was for that 1 month during COVID scare in February of 2020. It's only less than 5 years ago now. And it seems like it was a lot longer ago than that, but it was in February of 2020. The stock market went down 35% in 30 days. And it came back, it came right back. Okay. And it's much, much higher now than it was then.
Right. Right.
And the stock market, say in the last couple of years, the stock market's up 50%. It's not going to be, if it goes up 50% in the next year, 2, 3, it'll be pretty amazing. It's probably not going to do that. It might. We don't know. and the point is that we don't know, but over time, it has gone up 10% a year. And we can talk about, John, what you might want to break in here with a comment, but I want to say that I do want to talk about why we expect it to do that 10% a year over time.
Yes. Okay. And I just want to make one you know me. So, and another way to look at it, right? When you see the stock market go up 50%, you're like, yeah, that's great. That's great, right? And you see the market go down 50%, you're like, oh my God, we got to get out. Here's the reason why you don't want to get out and you want to keep doing it. When the market drops 50%, you're able to buy those stocks at a 50% discount, right? As long as you believe in what Andy is talking about in the long-term growth over the last 100 years, right? And that it's going to come back. That's a way to look at it. And again, the be greedy when others are fearful, be fearful when others are greedy. Did I get that right, Andy?
Yeah.
Right? When the stock market drops 50%, everybody's fearful. That's when you need to buy.
Yeah.
Just keep
And that,
going.
and
And,
that's
and
true.
over the last 100 years, it's worked out that way. So, all right, Andy, about
All
the
right. So you
future.
say, okay, well, that's great for the last 100 years, but all I care about is the next, 20 or 30 years, or 5 years, even 10 years. The first thing I would say, if your investment horizon is only a couple of years, you should not take the risk of being in stocks. Okay. Because the chances are pretty darn good that if you need that money in 2 years, it may not be worth what it is today. Okay.
Really great advice.
That's just
Yep.
one of the realities. So one of the things I say to people, and I've always said this in my career as well as in my book, is that if your horizon is, it really has to be at least 10 years to have a meaningful position in investment in stocks, or in this case, call it the S&P 500. It could be other stocks too, but call it the S&P 500, which is an index that, by the way, professional investors use the return on that index as their benchmark. If they can beat that index, they consider themselves to have done a really good job. But what I'm telling everybody is you can get that index yourself without hiring a professional. Okay. And it costs you as little as 0.03% a year to invest in that. Whereas investing with a professional is probably going to cost you 1% a year. Okay. And you say, 1% a year? That's not much. Well, maybe you want to talk to that point, John.
Okay. So I have done some numbers. Okay. And just real quick, I talked about the statistics on the number of people or the percentage of Americans that have $1,000 in savings. I got back answers of between 1/3 and 1/2 of Americans do not have $1,000 in savings. Okay. Um, that's a little bit alarming. So something to think about. Okay. So Andy talked about the power of compounding. I want to give you some examples because in this example, you're going to see the difference in that 1% Andy's talking about that you could pay an investment advisor. And we're saying, maybe you don't have to. Okay, so here's the thing. If you do think about, let's just go crazy, okay? And you're able to save $10 a day by not buying lunch and save $10 a day by not buying your lunch, not buying Starbucks, that kind of stuff, okay? $10 a day, that's 365 days, is $3,600 a year that you're going to be able to save just by paying yourself first. Now, if you save that money, $3,650, and you invest it in the Standard and Poor's, and there's no guarantees on the return, but historical return has been 10%. Okay, if you take that into the calculator, over 30 years, you're going to have not $109,000 that you saved. You're going to have $660,000. Okay, $660,000 by saving $10 a day and investing in the Standard and Poor's based on a 10% return, historical return. Now, if you do that and instead take 1% of that money and pay an investment advisor, okay, and instead make 9% on your money over that same period of time, and you're investing $3,650 a year. Instead of $660,000, you're going to end up with $542,000. That's a difference, folks, of what, $118,000 over the course of 30 years. The numbers don't lie. Okay. And as Andy is saying, 1% sounds like, oh, yeah, it's only 1%. And of course, a lot of people want you to feel like, yeah, it's only 1%. That 1% can cost you tens of thousands, if not hundreds of thousands of dollars, not millions of dollars over the course of that 30 years. So something to think about. So, okay, Andy. So I
Well,
think people get
let's just
mentioned.
examine, let's just explore for a bit why people might consider paying that 1% to
Yes, yes, thank you.
what the industry calls itself as terms itself as wealth managers. And to me, that term is pretentious. Okay. To me, health is wealth. The person with 1 million or 5 million has got lots of money. Are they wealthy? I don't know. It's a relative term, but let's
Yeah.
just assume for the moment that you say, okay, I want to go to a wealth advisor, so called. All right. Why do you do that? People do that because they get a comfort factor in that relationship because they met with somebody who is kind, is articulate, is knowledgeable, is comforting, and so they're willing to say, well, and they'll do it all for you. Well, number one is it's not their money, it's your money, number one. So what you're doing is you're hiring them to take risk with your money. What? Yeah, that's what you're doing. You're hiring
Huh?
them to take risk. You're paying them to take risk with your money. I can take risk with my own money and I don't have to pay anybody is basically that's the point of my book, frankly. And so how do you manage that risk? And that's a good question, and that's addressed in some detail in my book, but we'll talk about it here. And how you manage it is by having realistic expectations in any given year. So let's say you put all of your money into the Standard and Poor's 500, which, by the way, most people would not do, and I wouldn't advocate that. I would say you shouldn't put all of your money. You should put maybe most of your money, but not all of your money. Warren Buffett actually talks about putting 90% of the money into the Standard and Poor's 500. That's a pretty aggressive approach. Historically, it's been the most productive approach, but it's also aggressive and
Mhm.
hard to stay with because having the resolve to stay invested and keep investing when the market goes down is a lot easier said than done. Okay. It's terrifying. So, and I know this from my experience as a professional investor, working with fiduciaries who were responsible for endowment fund investments and pension fund investments and their own family's legacy investments. So this gets very personal very fast. Okay, so I'm talking about this is my reality. It's not some theory. Okay, so what are the expectations? What are reasonable expectations? Well, one of the things I do in my firm is to help people determine, precisely that using probability analysis, which again is determining risk, probability of risk. And but just in general, if you have money in the stock market, you can expect the market to go up on average about 10% a year. But in any given year, for 2/3 of the time, okay, it could be up 20 or down 10. So it can be up 20% in a given year, as it has been for the last couple of years, by the way, or down 10%. Now in 2022, it was down not quite 20%. Okay. So, but that's what to expect. You could reasonably expect your money will be, up 20 in a given year, 2/3 of the time or down. Now, what about the other third of the time? Well, it could be up a lot more than that, as it has been recently, or it could be down a lot more than 10, which it certainly has been in the past.
Right.
And that, and that's just one of the realities. So why does that happen? It happens because of fear and greed. And people get fearful and people try to, and they look at the future and they say, oh no, this is going to happen. That's now let's just back up for the moment. Some of us remember it was in early 2023 that the Federal Reserve, or actually it was 2022, when the Federal Reserve Board, which controls the money supply and credit in our country, started raising interest rates. And the narrative in the financial press at the time was that we would have a recession. The country would have a recession. Now that was in early 22. Here we are at the end of 24, almost 3 years later, And the economy's been doing just fine, thanks. Inflation, yes, inflation flared up because of the supply chain disruptions of COVID, and inflation is back down again. Yes, the price of eggs was up. It's actually down again. Food prices are actually flat this year, but still, most people say, "Oh no, they keep inflation's terrible. I was told it was terrible, and it's terrible." Well, it's actually subsided, but that doesn't mean prices are lower. It just means that prices are
Right,
going up at a
right.
lower
And people are
rate.
still having trouble. Yeah.
And that look, and the reality is in the last 20 years, the value of a dollar, the purchasing power of a dollar is down 40%. In the last 10 years, it's down 25%. And that's just, and we know that kind of, we know, oh my goodness, look at this cost, look at that cost. And has it been profiteering by companies that have taken advantage of the COVID situation? Probably, but that's a reality we live with. So, but getting back to how do you protect yourself from the forces, the pernicious and negative forces of inflation, and that is you have to assume some risk with your savings to do better than the rate of inflation. Now, historically, and this gets technical, but it's true, and you should understand it or try to
I don't
learn
want to
about
get
it.
too not too technical for me, please.
I'm sorry, what?
Not too technical for me. Yeah.
No. But the after inflation return is what you get to keep. Okay,
Right.
inflation is going to eat away at the power of your money. So what you get to keep is what you earn after. Now, inflation's say it's going to be 2% a year. Okay, and it's been more than that recently. It's been less than that. We had a decade in the great after the great financial crisis when it was less than 2% a year. And then we had COVID and it went up to 9% for a year or so. And now it's back down to 2.5% or so. Uh, but say it's 2%. Yeah, that's still do the math. So in 10 years, you're going to be down at least 20% in purchase. So you got to make more than two. So if you're only earning 5% or 4% in, say, in a money market fund, which is about what they're paying now, and they were, by the way, up until 2 years ago, they were only paying like less than 1%. But let's say four, and that's so if you have 2% inflation, that gives you a return of 2%. Well, if you have to pay taxes on anything, that's probably going to reduce your return by a lot. And we know we have to pay taxes. So you have to earn more than the rate of inflation. And the best way to have done that historically is by investing in stocks.
Right.
It's just the way it is. And people can say, "Well, I've invested in real estate." Well, real estate, and that's a good point. Real estate's been a great investment. And let's face it, we have been in this country, we've been able to buy houses with credit using a mortgage, and the price of our houses has generally gone up in the last 4 years. It's doubled basically. But for a decade before that, the price of houses didn't do much of anything. Okay. So the thing is that the price of houses is the rate of increase in the price of your house is really not what you're thinking because it provides you with shelter and safety and comfort. Okay. How do you put a price on that? So I don't look at real estate at one's home being an investment so much as it is a necessity. Okay.
But that
And
is,
it's been a
but having
necessity
said
that we've
that,
been able to get to enjoy because we have some advantages of being able to borrow and at relatively low rates. Now, when
right.
I was a young person with my first house, mortgage rates were 13, 14%. Okay. And then they went down to like under 3% after the, and so many people now have mortgage rates that are 3% or less, perhaps. And that's been great. And the price of the house has gone up, obviously, as I've already said, the last 4 or 5 years has gone up by, it's doubled basically, and or more. And so that's been great, but that's not always going to happen. So we can't really count on your house as being so much an investment as it is a place that gives you comfort and safety and convenience.
Right.
So,
Well, let me
and so
just make
real
a quick
estate,
comment on that.
can you invest in real estate? Yeah, you could. And a lot of people say, "Oh no, I only
No, no,
invest
no,
in
no,
real
no.
estate."
Hang
Well,
on,
that's
hang on, hang on,
great.
hang on, Andy. Hang on, Andy. Okay, so we're talking about real estate as your own home. Okay. We're not gonna, I don't want to get into real estate as investing, but real estate, if you want to take your money and invest in real estate, I have real estate investments myself beyond my own house. And I diversify my money between real estate and stocks. And so that is another option. But I just want to bring it back to stocks, and I want to give everybody a perspective on what we're talking about. Because we've been talking about risk, we've been talking about time, we've been talking about the S&P 500 and all these different kinds of things. I want to bring it back to the basics. When you own when you own stock in Apple Computer, you own a piece of Apple. Okay, that's what it is. And when you own a stock in Costco or in Amazon or in Microsoft or in Nvidia, you actually own a piece of that company. And so, as Andy is talking about having the companies work for you, that's what we're talking about. Okay, so I want to bring it back into simple terms because we have been talking about risk. We have been talking about the market going, but in the at the bare at the core level of what we're talking about, you are an owner of these companies. If you when you invest in the S&P 500, you are a fractional owner of 500 different companies. Okay, so I just wanted to make sure that we made that clear to everybody. Um,
That's
let
really an important thing. I mean, look, Johnson, what we're talking about here is mindset. Okay. So let's look at this opportunity to own a fractional piece of all these companies that are working for us as a mindset change. I'm not working for them, or maybe I do. Maybe I do work at Walmart, or maybe I do work at, Apple or these other corporations, and to make a living, and to challenge myself to make a living and make a contribution to the world, frankly, and add value. But also just look at it as we already said. It's just like those corporations are working for you if you own a piece of them. And that's pretty cool. And most people don't even think of it that way. They think, oh my God, those corporations are terrible and they're gouging prices. And no, well, you can benefit from corporate strategies. And I didn't say this before, but so why would we expect in the future stocks to do what they've done in the past? And the bottom line answer to that is that corporate managements have a duty to their shareholders to return money and a reasonable return to their shareholders. And they do everything they can every day of the year, frankly, to do just that. So think of them as working for you. And no, some companies fail. Yes, they do. And they get replaced by other companies, and companies change. So we all know about what happened in the retail world with Amazon in the last 25 plus years. Okay. And it's changed. And now some companies that were stalwarts of our economy, Sears, which most people don't even know exists anymore, or Kmart or others, have, they've disappeared essentially. They've
right.
disappeared. Why have they? Because they didn't add value to the consumer the way Amazon has been able to add value to the consumer. And of course, many of the other companies, Walmart and others, have gone to online sales and just, and delivery and so forth. So we know what that means. And one of the reasons that we can invest, as we've been talking about, in the stock market now, is because that was not the case 25 years ago. You didn't have the opportunities to invest for almost no minimums and for very low costs, but you can now because competition in the industry has made it accessible to average people to invest. And so let's take advantage of that. So our world has changed to our advantage. So, is it
Absolutely.
ideal? Probably not. Is it going to get better? We hope so. Could it get worse? Possibly, but it's been pretty darn good. So let's just look at it that way.
Yeah, absolutely. Andy, can you talk just a minute? Let's finish up this segment on investment wealth managers. I see this commercial happening all the time about fiduciaries, and guy gets up and he says, we're a fiduciary to you. The more money you make, the more money we make. And that sounds really good. When you make money, we make money. Can you talk to that just for a second?
Well, yeah, of course. All right. First of all, what is a fiduciary? Okay, a fiduciary is a legal term. It's a legal responsibility to put a client's interests before one's own. Okay. So you have to put the client interest first. And the fact of the matter is that every registered investment advisor in the country, and the registrations are under the U.S. Securities and Exchange Commission, as well as state securities administrators. So it's a heavily regulated industry. All the registered investment advisors who would be wealth managers, okay, must by law be fiduciaries. So for people to say that, oh, well, we're fiduciaries, well, that's true, they're fiduciaries, but so is every other investment advisor. Now, In contrast, and the distinction here is that brokers, okay, and we call them the brokers, stockbrokers call it. Brokers are not, they do not have a legal requirement to be fiduciaries. They do, since June of 2020, however, have more stringent disclosure requirements to their clients. Now, the brokers do not necessarily have to put the client interest first. So beware of that, because brokers may be promoting something that's more in their interest than in the client interest. That's possible. I'm not saying that they do that, but they can do that, and they legally can do that as long as they fulfill these disclosure requirements. So just be aware of that. But when you're dealing with investment advisors or wealth managers, so-called, they're all fiduciaries. There's no distinction. And then what John said about they make money, well, we're fiduciaries. We only make money when you make money. That's not true, because they make money. They charge fees based on the assets under advisement. So if they have $100,000 account and they're charging, say, 1%, it could be more, it could be less. Okay, so they're getting $1,000 a year for the 100,000. Now, if the 100,000 goes down in the value by 10%, goes down to 90,000, well, they're only getting 900 a year, but they're still getting paid. And oh, by the way, they're getting that 1/365th of that every day of the year, whether they do anything or not. Okay, which is really the point of my book. What are they really doing? The most important thing to me that the investment management industry does is help people determine their investment appetite, their tolerance for risk. How much risk can they tolerate? And hopefully they determine that before they exceed it. Okay. And that's really an important point. How do you do that? Well, and I've talked about that already, but it's possible to do that. And we have actually, in my decades of experience, we've actually done it. And you have to do it to be successful, but in investing. But anyway, so fiduciaries, then what they do is they help people devise a strategy that hopefully is an enduring strategy. What do they do after they implement the strategy? Unless they're trading stocks on a regular basis, daily, weekly, monthly, or even annually, there's really not much point. Most of them are investing in index funds or exchange traded funds, and sometimes
Like the
mutual.
S&P 500.
Yeah, and the S&P 500 or other indices of securities. And so if they are going to do that, the numbers are pretty straightforward. Let's assume, as we said earlier, that the Standard & Poor's 500 does 10% a year, but you're paying an advisor 1% a year. Well, if you're only getting 10% and the advisor, so you pay one, you only get 9. Well, that doesn't make any sense. Why would you do that if you can do that on your own? Okay. Why would you do that? So what really has to happen is the advisor has to make at least 11% for you to be on an even footing with the advisor. Okay. And they really should be making more like 12%. So they're actually adding value after their fees. So
Right.
the questions that you could pose, and again, they're on my website in the book, and it's straightforward. How do you add value to my account, Ms. or Mr. Wealth Manager? And you should get a straightforward answer. So that's the point. It's not
Yeah.
it's not I'm not denigrating an industry. What I'm saying is that they have to be. I'm pulling the curtain back on practices such as this advertisement that says, well, we're fiduciaries and we only make money when you make money. No, the reality is they make money even when you don't make money. And they don't say that, though, do they?
No, they
Why
don't.
don't, why don't they say that? And oh, by the way, the other thing they don't say, and this is a legal requirement under the Securities and Exchange Commission, all investment advisors must tell their clients that their fees are negotiable. That doesn't mean that they'll lower their fees if you ask, but they have to tell you that they are negotiable.
Oh,
That's a
interesting.
fact.
Okay. And folks, I mean, we just talked a little bit earlier in the episode of what the value of 1% can be. Okay, a value. Andy just talked about, the benchmark is the Standard & Poor's 500, 10% over the last 100 years. If you know if they're going to add value at 1%, you're paying them 1%. They have to make a 12% return on your investment. And that's really, really hard to do. So just think about that. Think about, if nothing else, what we wanted to do with this episode is to kind of enlighten you, kind of give you, really give you some of our own experiences over the years, because that 1%, again, can be tens of thousands, if not hundreds of thousands, if not millions of dollars over the course of 30 years. It's crazy, right? And this alone, this part of it alone is something that can really make a difference in your life. The other thing that Andy and I are talking about is to learn. Okay, I can think of nothing that will give you a bigger return on your wealth than learning how to build wealth. And we just gave you, I mean, Andy, you're just amazing. And for you to spend this time um, sharing your experience over the last 40 years, how do you learn? Go to Fidelity, go to Vanguard, go to some of these financial companies and learn. Call them up, ask them questions. Andy mentioned Warren Buffett videos on YouTube. Oh my gosh. I mean, that is just watching his videos. I learned more watching his videos than I did getting my MBA. I mean, it's just crazy because you're learning from real life experience of people who have been there and done that. And so, and the other thing I'll tell you, and Andy, maybe you can talk to this for a second, but the other thing I'll tell you is that it's being really hard to be disciplined, easy to make the decision. It's hard to keep to it, right? Get a buddy. Find a friend who will maybe go through this. But I'll tell you, even having somebody who you can check in with once a month and just say, "Hey, listen, I need you to pump me up." It can be huge so that you're not out there on your own. And when you panic, have somebody. Maybe that somebody could be Andy. But I will tell you, having a buddy out there, be it a friend or a relative or somebody who shares your interests and perhaps wants to do the same thing, can be a really great thing. And again, it's a lot more simple than you might think it is. So learn, learn. My father-in-law once gave me some of the best advice I ever got. He says, people enjoy doing what they're good at, whether it be engineering, whatever it is. People enjoy doing what they're good at. So get good at it. Whatever it is, get good at it, right? You may not, you may, understanding wealth building may not be something you're good at now. I would love for you to get good at it because it's going to pay off. All right, Andy, last comments.
Yeah. Well, John said it's like doing anything else. You have to be consistent and disciplined. And one of the things I've said to clients over the years is one of the structural advantages that anybody has, and it's not a proprietary thing, but it's just if you are disciplined and you look and you review your investment program on a regular basis. That doesn't mean every day, but at least once every 3 months or so. Uh, that's important. And look at it relative to, how does it compare to your strategy? Is there anything that you should do that you should really change that departs from your strategy? But there's an advantage to a regular disciplined review on a quarterly basis. And I would highly advocate that people do that because it's so easy to not look at that statement of your investments when the market is down. Okay. It's really, oh my God, I don't want to look at that. It's just too easy to essentially to be in denial. And that's what people do. But you have to force yourself to be disciplined. And it's like training. If you train for a week, you're not going to see much progress. If you train for a month, you might see a little bit. If you start training for on every week, several times a week, after 3 or 4 or 5, 6 months, you're going to see some difference. And that's exactly what John's talking about. Learn and put the time in and the work in, and you'll benefit. And I guess I would leave everybody with this statement, which sounds pretty unusual coming from an investment person, but look at this as investing with joy and peace of mind. Okay. Don't look at it as a chore that you dread. Look at it as something to embrace and be joyful about. Anyway, that's the way I look at it.
That's awesome. That is so, I mean, you talk about a mindset shift. That is so cool, Andy. And the other thing I'll tell you, given your example of starting to work out, when you start working out and you have this vision of being an elite athlete or whatever it is you want to be, starting out can be really painful. I mean, it's like because you're learning and your muscles are you're using muscles you didn't use before, but you just keep at it. You just keep at it, and you keep the more you learn, the more you learn. Learning is cumulative, and it just keep going. And so I'll just tell you that as you're getting started. Um, it's hard because you're just like, oh my gosh, it's just $100. Oh my gosh, it's $200. But I'll tell you something, the thing that happens to everybody is you keep on doing it, and one day you wake up and you go, wait, is that right? Right? I mean, it just works that way. So with that, folks, I hope please share this. Please share this with folks because the insights and the wisdom that Andy just gave is amazing. If you want to learn more, uh, Andy's book is called Beat the Wealth Management Hustle. Okay, and a big part of that is learning and kind of doing it yourself and figuring it out. Okay. Andy, thank you for joining me. This has just been amazing. And I'm gonna go back. I was just gonna say rewind this tape, which, which just ages me right there. But I'm gonna go through this a couple more times to just make sure I got everything. But anyway, Andy, thank you again for joining me. Everybody, thank you for joining. God bless you. I love you. And please subscribe, please share. And here's to you. And here's to you in building your wealth. All right, we'll see you next time. Bye.